Hi there, and thanks for joining us on PhillipCapital Market Watch. I'm Boon Siang, Equity Specialist from Phillip Investor Center. 2020 has had a rough start in the first quarter, with the COVID-19 situation sending markets into a downward spiral, and Singapore REITs were also not spared from the sell-down of shares. Today, we will be taking a look at some of the measures proposed by local authorities to help Singapore REITs tide through the COVID-19 situation and understanding the impact on their shareholders. On 16 April, the Ministry of Finance, the Inland Revenue Authority of Singapore, and the Monetary Authority of Singapore jointly announced new measures to provide Singapore REITs with greater flexibility to raise funds and manage their cash flows during this trying environment. Two main measures were proposed. First, an extension of timeline for distribution of taxable income by MOF and IRAS. Second, the raising of the leverage limit and deferment of new regulatory requirements by MAS. Previously, REITs were required to distribute at least 90% of their earnings within 3 months to shareholders. REITs now have a longer period of 12 months to distribute at least 90% of their taxable income for financial year 2020. For example, REITs with financial year 2020 ending 31st March 2020 will be allowed until next year 31st March 2021 instead to distribute their taxable income. So what does this mean for shareholders? This may address some concerns that REITs may have needed to raise equity through rights issue in order to meet MAS requirements. This would have in turn caused a dilution of shares and dilution of dividends per unit. Similarly, the MAS has raised the leverage limit for Singapore REITs from 45% to 50% and delayed its requirement to have a minimum interest coverage ratio of 2.5 times until 1st January 2022. Interest coverage ratio, ICR, is a measure of a REIT's ability to service its debt obligation from regular sources of income, and the purpose of a minimum ICR helps to strengthen the REIT's debt servicing ability. Leverage limit, or also known as gearing ratio, is the debt to asset ratio. During this environment, a REIT's asset may devalue as the economy deteriorates and thus have a higher gearing ratio. Overall, this eases the pressure on Singapore REITs as it provides a temporary buffer and a more manageable time frame to combat potential bad debt and manage their cash flow mismatches arising from this pandemic. For investors who are looking to enter REITs, we can expect in the short term for REITs to cut down on dividend payouts if required, in order to put them in a better position for the longer term outlook. This will also allow Singapore REITs to compete more effectively against its global REITs peers. In terms of sector outlook for REITs, we can expect to see faster recovery in commercial and industrial REITs when the economy shows signs of improvement. Hospitality and retail REITs may take the longest to gain traction as global demand of travelling and tourism is hit the hardest. It may take a while before domestic consumption and the demand for vacation abroad recovers. With that in mind, do expect further hurdles in place during this difficult time, not just for REITs, but for the Singapore economy in general. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Tell us, what do you think? Will you be adding REITs into your portfolio? Leave your comments. Thanks for joining us and see you soon.